Alright, gang, it's your boy Nature, aka Nature. I just jump right back into it. So, to open this position, we already know your requirement for a margin requirement. For this was 2%. You know, $100,000 for USD. 2% of that will be 2,000. 10,000% of that, 2% would that be 200, and 1,000, 2% of that would be 20. So in this example, open a long USDJPY position. Let's say that you deposit $1,000 into your account and you want to go long USDJPY and you want to open one mini lot of 10,000 units per position. Okay, so how much margin will be needed to open this position? Okay, so since your USD is the base currency, this mini lot is $10,000. Okay, so which means that the position notation value is $10,000. So the notation value is $10,000. The same thing as the mini lot, which is $10,000. The required margin to hold that trade is 400. So assuming that your trading account is denominated in USD, since the margin requirement is 4%, the required margin will be 400. Okay, so your balance and the required margin to hold that position is 400. So open a long, let's say, look at another example. So open a long JPUSD position. Let's say that you deposit 1,000 to your account and you want to go long GPUSD at 1.3 thousand, and you want to open one mini lot of 10,000 units position. So how much margin will be needed to open this position? Since GPU is a base currency, this mini lot is 10,000 pounds, which means that the position notation value of that is 3,000. Okay. So assuming that your trading account is denominated in USD, since the margin requirement for JPUSD is 5%, the required margin will be 650. Okay, so from your balance. So let's open another position and look at another example of Euro slash Aussie position. Let's say you want to go long or Euro slash Aussie and you want to open one mini lot, which is $10,000 a unit as a position. How much margin will you need to open this position? Okay, so assuming that your trading account is denominated in USD, you need to first know what the Euro USD price is. Let's say that Euro USD is trading at 1.500. Since Euro is the base currency, this is a mini lot of 10,000 euros, which means that position notion value is 11,500. Your required margin will be 345. So since the margin requirement is 3% of that, the required margin will be 345. So this is how you come up with your balance and your required margin for that. Okay, so how to calculate the required margin? When trading with margin, the amount of margin, required margin, which is the required margin needed to hold an open position, open that open position, is calculated as a percentage. So the margin requirement of a position size is a notation value. Okay, so the specific amount of required margin is calculated according to the base currency of the currency pair traded. And this, if the base currency is different, your trading account currency is different. So the trading required margin is converted into your account denomination. And it's all done MetaTrader for you, but this is this is just the proof of it. Here is the formula to calculate the required margin. If the base currency is the same as your account currency, required margin equals notational value times margin requirement. If the base currency is different, your account currency is different. Okay, so required margin equals notation value times margin requirement times the exchange rate between the base currency and the account currency. The only reason for having funds in your account is to make sure you have enough margin to use for trading. Okay, margin allows you to open up more than one trade. Okay, when you open up a trade, it becomes used margin or usable, required margin, which is held and locked up until you close that trade, and then you can get that margin back. When it comes to trading Forex, your ability to open trades is not necessarily based on the funds in your trading balance. More accurately, is based on the amount of margin you have. So this means that your broker is always looking to see if you have enough margin in your account, which can actually differ from your account balance. Okay, so it sounds a little confusing, but you don't worry, it will start to make sense as we proceed. So let's recap. In this lesson, we learned about the following. Margin requirement is the amount of margin required to open a position. It is expressed as a percentage of the full position size or the notation value of position you wish to open. Required margin is the amount of money that is set aside and locked up when you open a position. So it's locked up when it's required margin. Okay, margin requirement is the percentage of that full position or size of that notation value of that position that you wish to open. And the required margin is the amount of money that is set aside or locked up when you open that position. So in this previous lesson, we learned about what is margin trading, learn why it's so important to understand margin account, why it works, what is your balance. Your account balance is the cash that you have in your trading account. What is unrealized and realized profit / loss, and know how to profit, or and it's know is which is the profit and loss of your account, and your balance is the unrealized and realized profit / loss. So let's move on to learn about the concept of use margin. So what is use margin? So what is use margin? What does use margin mean? In order to understand what use margin is, we must first understand what required margin is. Whenever you open a new position, a specific amount of required margin is set aside. Required margin was discussed in details in the previous lesson, so if you don't know what it is, please read our what is margin lesson first. If you open more than one position at a time, each specific position will have its own required margin, okay, for that position size. It has its own required margin to even open that trade. If you add up all the required margins of all those positions that are open, the total amount is what's called the use margin. Okay, so the use margin is the required margin of all the positions that are open in total. So the use margin is all the margin that is locked up and can't be used to open a new position. Okay, it's use margin. Okay, it's locked up margin that you can't use to open a new position. This is margin that's already been used, hence the name use margin. While required margin is tied to a specific trade, use margin refers to the amount of money that you need to deposit to keep all those trades open. So let's say for this example, you open a long USDJPY and USDJPY position. Let's say you deposit $1,000 into your account and you want to open two positions. You go long on USDJPY and you open one mini lot of 10,000 units position, and you go long on USD France and you open one mini lot of 10,000 units position. The margin requirement for each currency pair is the following. So the currency pairs is on the left, USDJPY, USDJPY. The margin requirement to open that currency pair is 4% and 3%. 4% for USDJPY and 3% for USDJPY. How much margin will be needed to open each position? 3 and 4%. So since the USD-based currency for both currency pairs of a mini lot is $10,000, which means each position notation value is 10,000. Okay, so let's calculate the required margin for each position. So USDJPY position, the margin requirement for USDJPY is 4%. Assuming that your trading account denomination is USD, required margin for that would be 400. So you do the required margin and the notation value times the required margin, and you get 400. So you do 10,000, which is the notational value, times the margin requirement for that trade for your for USDJPY, which is 4%, and you times 10,000 times 0.04%, and you get 400. Same thing with USDJPY position. The margin requirement for USDJPY is 3%. Assuming your trading account is denominated in USD, the required margin will be 300. The required margin is the notational value, which is 10,000 times the margin requirement for that trade is just 3%. So you do 10,000 times 0.3%, and it gets you 300. So now you have two trades open. Since you have two trades now open and you have used your margin trading account, it will be 700. So the use margin is the sum of the required margin from all of those open positions. So you take simply 300 from USDJPY plus the 400, or 400 plus USDJPY plus the 300 from USDJPY, and it gives you the use margin, which is the sum of the required margin of both of those trades, or all those trades. So now you have a use margin of 700. Here are core diagrams of a use margin relates to a required margin and balance. So required margin for USDJPY 4% was 400, USDJPY 3% was 300. You put them both together, it gives you the total balance of both those required margin, which is called use margin, which is 700. If you combine 400 plus 300, it gets you 700. Your balance is 1,000. So this is how use margin is worked. This is how you use margin. So we're going to recap on this in this lesson. So in this lesson, we learned about the following. Use margin is the total amount of margin currently in use of maintaining all positions. Said differently, is the sum of all the required margins being used. In the previous lesson, we learned what margin trading is, learned why it's important to understand how you use your margin in your account works. What is your balance? Your account balance is the cash that you have available in your trading account. What is unrealized and realized profit / loss? Is know how the profit or losses affect your balance. That has to do with unrealized and realized profit or loss. Has to do knowing that is to know how profits or losses affect your account balance. That has to do with unrealized and realized profit and loss. What is margin? Is the required margin is the amount of money that's set aside to lock up those positions that you have open. So let's move on and learn about the concept of equity. Okay, so this is very important. It's all have to do with margin trading. So what is equity? What does equity mean? The account of equity, or simply equity, represents the current value of a trading account. Equity is the current value of an account and fluctuates with every tick when looking at a trading platform on your screen. It is the sum of the account balance and all floating unrealized profits and losses associated with your open position. As your current trade rises or falls in value, so does your equity. Okay, so it is the sum of your basically your balance. Okay, but it's the sum of it from all the floating and profits and losses, unrealized profits and losses, and realized profits and losses that has to do with your equity. So as your current trade rises or falls in value, as the market rises and falls in value, so does your equity. So how to calculate equity if you have no open trades? Okay, so no trades open. If you don't have any open positions, your equity is the same as your balance. Okay, so your equity equals your account balance. Okay, so in this example, account equity, when you have no open trades, when you deposit $1,000 into your account, since you haven't opened any trades yet, your balance and your equity is the same. Okay, so your equity is 1,000, your balance is 1,000. So how to calculate equity if you have trades open? If you have open positions, your equity is the sum of your account balance and your account floating profit / loss. So equity equals the account balance plus the floating profit / loss. So account equity, when existing trade is losing, what happens? This is an example of account equity when you're losing a trade. So you deposit $1,000 into your trading account. Let's say that Beyonce says that it will go short, which means sell, and price moves against you, and you trade, and the trade shows a floating loss of 50. So your equity equals the account balance plus the floating profit or loss. So 950 is now your equity. So the account balance equity is the account balance, which is 1,000, plus the floating profit or loss, and your floating loss, you had a floating loss of 50. So now your equity is the balance of both your account balance and floating profit or loss, and you lost 50. So now your equity is at 950. Okay, so your equity in your account now is at 950. You had a floating loss, a floating profit loss. You haven't closed the trade yet though, but your equity is still down because the floating profit loss until you close that trade is 950. So in this account equity, when existing trades is winning, say for let's say example, if you're winning right now, what does your equity look like? So say Beyonce again says that she changes her mind and say go long on GPUSD. Not only is she crazy in love, but she seems like crazy in trading also. But she's queen bee, and she says go long also. You go long. Okay, so move price immediately favors in your trade shows a floating gain of 100. So your equity is the account balance plus the floating profit or losses. So you have a floating profit. Your account balance is 100, is 1,000, plus you have a floating profit of 100. So you have a floating profit of 100. So your equity now is 1,100. Okay, so your equity in your account now is 1,100 because you have a floating profit of $100. Your account equity continues to fluctuate until you actually close that position. With the current market prices, as long as you have an open position, your equity will fluctuate. Okay, until you close that position. Equity shows the temporary value of your account at the current time. Okay, this is how you can keep up with your account by looking at the equity. This is how you can tell the overall, of your account temporarily is by looking at the equity. So your equity shows the temporary value of your account as it fluctuates up and down, as the market fluctuates up and down at the current time. Okay, so it shows you the value of your account at the current time. Okay, unlike a tattoo that is permanent, it's temporary. Okay, now that's why equity is seen as a floating account balance. It will only become your real account balance if you were to close all those trades immediately. What is the difference between balance and equity? So let's say with a simple answer, if your account is flat or does not have any positions open, then your balance and your equity are the same. Once you open up an account or a balance, then then that equity in your account balance is different. But if you do not have any open positions, this is when your balance and your equity is. But if you do have open positions, if you do have open trades, then this is when your balance and your equity is different. The balance reflects your profit/loss from your closed position, and your equity reflects the real-time calculations of your profit/loss. So your equity takes into account both open and closed positions. This means that when you're looking at your balance, it's not actually real-time amount of your funds, okay? It's only real time. It's only temporary. Equity is temporary until you close that position. So that's what equity is. It's a temporary of your balance until you close that trade, whether you're in profit or loss. Okay, so that's what equity is. That's how it's different from your account balance. Okay. So this means that when you're looking at your balance, it's not the actual real time of the amount of your funds. Since equity includes current profit or losses from the opening trade, it is the equity that shows the real-time amount of your funds. Okay, so you really look at your equity, it will show you the real-time amount of your funds compared to your overall balance of your funds that you put in. Okay, so it's possible to have a very large balance but a very small equity. Okay, this happens when you open position and you have a large unrealized floating/loss. For example, if your balance is 1,000 and you have an open trade that has a floating loss of 900, your equity is only $100. Okay, you have a floating loss of 900. So, and your equity is the current balance of what's really going on currently. Okay, so your equity is now $100 because you have a floating loss of 900 and your balance was 1,000. So that's recapping this lesson. We'll be learning about the following. Equity is the account balance plus the floating profit/loss of all your open positions. Equity represents the real-time value of your account. In the previous lessons, we learned what margin trading was, learned why it's so important to understand how a margin account works, what is your balance. Your account balance is the cash you have available in your trading account. What is unrealized and realized profit/loss, also known as profit or loss that affects your balance. Okay, so unrealized profit and realized profit and loss is the profit and losses that affect your balance. What is margin? Margin is the required margin and the amount of money that is set aside, that is locked up when you open a position. What is used margin? Used margin is the total amount of margin that is currently locked up to maintain all open positions. Okay, so let's move on and learn about the concept of free margin. So what is free margin? So what does free margin mean? Margin can be classified as either used or free. Okay, so used margin is the aggregate of all the required margins from all open positions, which we discussed in the previous lesson. Free margin is different between equity and used margin. Free margin requires you is referred to the equity. A trader account is referred to the equity in a trader account that is not tied up in margin for a current open position. So free margin is also known as usable margin because this margin that you can use, okay, it's called usable margin. Okay, so this is margin, free margin, or used margin that you can use. Okay, so it's on top of what you already have open. Okay, this is thought of as in two things: the amount that's available in your open new position, and the amount that existing position can move against you before you receive a margin call or stop out. Okay, so it's the amount available to open a new position. This is what free margin or used margin is. And it's also the amount of existing positions that can move against you, and then you can be called and for a margin call, or you can be stopped out by your broker or your trader, your broker. So don't worry about margin call and stop out. We'll discuss that later. For now, we'll just want you to understand. What free margin is. Okay, margin call out and stop out margins are like acme breakouts. You don't want to experience them. Okay, so free margin, also known as usable margin, usable maintenance margin, available trading to use. Okay, so how to calculate free margin? Here are how you can calculate free margin. So free margin is the equity minus the used margin. Okay, so if you have an open position and that you are currently profitable, your equity will increase, which means that your free margin will increase as well. Flowing profits increase equity, which increases free margin. If your open positions are losing money, all your open positions that you have are losing money, your equity will increase, which means that your free margin or your used amount of margin that you can use for that trade or open a new trade will decrease as well. So free margin is just that important. Floating losses decrease equity, which decreases your free margin, and profitable, and floating profits increase your equity, which increases your free margin to use. So as an example, we open up a position. I said that you have no positions open, and you deposit $1,000 into your trading account, and you don't open any position. What is your free margin? So if you don't have any positions open yet, your equity equals the account balance plus your flowing profits / losses. So your $1,000, you have no open positions, so your equity is at 1,000. Your equity will be the same as your balance. Since you don't have any open positions, you don't have any floating or profits / losses open yet either. So your equity and balance is the same. So to calculate that, if you don't have any open position, then your free margin is the same as your equity. Okay, remember, free margin is the equity minus the used margin. And since you don't have any trades open, you don't have no used margins open, so your free margin and your equity is 1,000. Okay, so since you don't have any open positions, there aren't no margins being used. This means that your free margin will be the same as your balance and your equity. So your free margin is 1,000, your equity is 1,000, and your balance is 1,000. So open up a trade, and you go USDJPY on a position. Now let's make it a bit more complicated by entering a trade. Let's say that your account balance is at 1,000. You calculate the required margin. You want to go long, so USDJPY wants to open 1 mini lot size, which is $10,000 a unit position. The margin requirement is 4%. So how much margin required is needed to open that position? Since USD is a base currency, this mini lot is $10,000 a unit, which is the position notation value of 10,000. Okay, so the required margin is the notational value times the margin requirement will give you the required margin. Okay, so we already went over that in the previous session. The notational value is 10,000 times the required margin for that will be 0.4, which gives you your required margin of 400. Okay, your margin requirement will get you your required margin of 400. Okay, so the margin requirement to open that trade is 4%. The required margin will be 400. Okay, so the required margin is 400 to open that trade. Your balance is 1,000. So to calculate the used margin set aside from the trade we just entered, there aren't any trades open. Since we have only one single position open, the used margin will be the same as the required margin. So the used margin and the required margin are the same. It's 400. So your balance is 1,000. Okay, so to calculate the equity, let's assume that price has moved slightly in your favor and your position is now trading at a break even. This means that your floating profit / loss is 0. Let's calculate your equity. Your equity account is at 1,000. Okay, your balance is at 1,000. Okay, so to calculate the free margin, now look at the equity, and now we can calculate the free margin. So the free margin equals your equity minus your use margin. So your use margin is 400, plus your equity is at 1,000. Okay, so your equity is at 1,000 minus the use margin, which is at 400, gives you your free margin of 600. So this is how you get 600 in free margin. As you can see, another way to look at equity is the sum of your use and free margin. So your use and free margin will give you your equity. Okay, so your equity is your use plus your free margin, which gives you your equity. So in recap, in this lesson, we learned about the following. Free margin is the money that is not locked up due to open positions and can be used to open new positions. And free margin is at zero or less additional positions that cannot be open. If you don't have any free margin, you can't open no more positions. So in the previous lesson, we learned what margin trading is, learned why it's so important to understand margin in your account and how it works. What is your balance? Your account balance is cash that you have available in your trading account. What is unrealized and realized profits as loss is known as your profit, and loss that affects your balance. What is margin? Margin is the required amount of margin that's held up or set aside or locked up when you open a new position. What is your use margin? Your use margin is the total amount of margin that's currently locked up to maintain all that open position. And what is your equity? Your equity is the balance plus your floating profit or loss of all your open positions. Alright, so in this next video, we're going to discuss, let's move on and discuss the concept of margin level. Okay, so what is margin level? Okay, and this is going to be the last video for right now, and we're going to jump back in and give you part 3 and part 4 soon. So what is margin level? So what does margin level mean? Margin level is a percentage of value base of the amount of equity versus use margin. Okay, so it's a percentage of the equity versus your use margin. So a margin level allows you to know how much of your funds are available for new trades. And it's another way. Okay, so the higher your margin level, the more free margin you have to trade. Okay, the larger your margin level, the less free margin available to trade, which could result in something bad like a margin call and a stop out, what we'll discuss later. How to calculate margin level. So how to calculate margin level will be your equity minus divided by your use margin times 100. So your trading platform will automatically calculate display this in your margin level for you, but it's good to know it. Okay, so if you don't have any trades open, your margin level will be 0. Margin level is very important